Welcome, everyone. Today, my guest is Lead Analyst Logan Mohtashami to talk about the Fed, the labor market, and when we might get a break on mortgage rates. First, here's a word from our sponsor. This is Sarah Wheeler, Editor-in-Chief at HW Media, talking with Christina Bennett, Senior Vice President of UWM Sales, about a career in the wholesale channel. Christina, what have you seen happen in the wholesale channel over the past 6 months?
Yes, Sarah, we've seen some great growth in the wholesale channel over the past several months. Specifically, every single week, we're getting hundreds of phone calls from retail loan officers calling in to find out how can they join an independent mortgage broker? How can they become an independent mortgage broker? And quite honestly, just realizing that wholesale is better for consumers and a better place for them to work as well.
Thanks, Christina. And listeners, you can go to beamortgagebroker.com to get more information. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah, on Jobs Friday, one of the most fun days of the year.
Well, it is fun with you, so let's jump right into it. What happened on Jobs? Was it what you expected?
Well, again, the honey badger labor market continues, but I think, when I wrote that article on Friday, I'm trying to explain to people why we still have big jobs numbers. So again, going with the work, right? Because we believe in economic models, right? The people that do modeling works tend to get it right. Here, part of the COVID-19 recovery model was, we're going to get all the jobs back lost to COVID by September of 2022. And that roughly hit the spot. But if you look at the labor market and just assume there was no COVID, right? The longest economic and job expansion ever recorded in history was going, right? Housing broke out before COVID-19 hit us. So assume that to be the case. We should have between 158 million to 159 million jobs. If we wanted to say that we get some weakness in the labor market, it'd be between 157 million to 158. So we're still in makeup mode in my mind. And this is why I've talked about this a lot, that once we get closer to those numbers, the job growth data should slow down noticeably. But when you're in makeup mode, and I think the thing is that after 2008, we had the weakest economic recovery ever. We had the weakest housing recovery ever. So it took so many years to get back to the point of all the jobs we lost during the great financial crisis. We don't have that type of recovery. So when you have a fast recovery, the need for labor is there. Why? Because the consumer's still there. And after 2008, we had years and years of deleveraging, meaning people were filing for foreclosures, bankruptcies, which means those consumers are not in play, right? If you weren't part of that, then you're doing the normal consumption pattern. So we're working from a full head of steam on the consumption side. Of course, when mortgage rates skyrocketed, the housing market went into recession. But in general, we're a domestic-based economy that is getting kind of like a manufacturing construction boom on top of that. So if you look at it in that light, then I think we've beaten the job estimates like 14 months in a row. Then it starts to make sense, even with the Fed rate hikes, even with the inflation period. Consumption is still moving, and as long as consumption is still moving, the labor force is in makeup mode. And then once we get to 157 to 158 million around there, then you start to go back to, okay, the easy part of the labor recovery is over with now. The Fed rate hikes and credit getting tighter, all those things will come into play. But at that point, you need jobless claims to break nationally. I would say, there's noticeable claims increases in about probably 25 states already right now, but we're not there yet for the total economy to get, or the Fed hasn't achieved its job loss recession just yet.
So where are we on that total number?
Oh, we're just a tad above 156 million. So we're not there yet. It's achievable by the end of this year if job growth keeps on going pretty easily. I mean, just there's an average of 200,000 reports for the next few months. We could get through 157 million. But hopefully that explains the labor market strength in that context.
Well, it is confusing if you think about, we say the Fed wants a job loss recession. But we still haven't gotten all the jobs back. So as we're adding those jobs back, are they considering it, oh, we're growing instead of just getting back to where we want to be?
So the Federal Reserve, to me, wants the slow recovery that we had in the previous expansion because it's all about inflation. Wage growth picking up? No. We can't have that in America. If wage growth picks up, people make more money. That's bad. The bosses would have to pay up for labor and, inflation will take off. So what's the irony of everything? And this is why I've always stressed the people that believe we're in 1970s are so petrified of wage growth. But during 2022 and 2023, where in theory we had the tightest labor market ever, that's what they say. The Fed says this all the time. The labor market is too tight. Wage growth has been slowing since January 2022. It's still higher than what we had in the previous expansion, but that was the weakest recovery ever. They like that. So they want us to go back there. Right? These are old people that just want slow wage growth and everybody just let the bosses not fight over you. So here, wage growth has been slowing down. If you had a wage spiral, the fear is always that wages spiral out of control, right? And then inflation goes rampant like in the 1970s. And this is why we have to be mindful of anybody who talks about the 70s, because if this is true, wage growth would be accelerating noticeably. Not the case. So they're hoping that the higher rates and the credit getting tighter. I think they really love the fact that credit's getting tight. I was actually just joking about this today on Twitter. I said, "Boy, the Federal Reserve loves that the mortgage spreads are terrible." I mean, the mortgage rates, if being at 5.5%, do you know how the panic the Federal Reserve would have? Waller talks about a rebound in housing with demand at 10-year lows. Could you imagine if we actually had positive purchase obligation data every single week? He would freak. He would panic. He'd be sweating. You'd go, oh my God, younger people are buying homes and they're having sex and they're buying homes again. And I can't have that because I couldn't buy a home when I went to Washington, D.C. My friends are buying homes now more than the millennials. So we have to keep this going. So it's starting to get ridiculous now on the housing thing with some of the Federal Reserve members. But the spreads being worse after the banking crisis is something that the Federal Reserve enjoys. And this is why you don't hear them talking about it. Like in any other time, people would be like, wow, the spreads are like, usually you're in a financial crisis or something. Here, where our economy is expanding and they're like, hey, let's just let this be, because I think the fear of Americans buying homes for them is too much. And that's why you don't hear any comments on the mortgage-backed security spreads or anything like that. They love it. They love the fact that credit was getting tighter. Not only did they love the fact that the credit was getting tighter, they were hiking when they knew the credit was getting tighter. And, if they're going, well, we're going to pause here maybe. But I think in that sense, the Fed is getting what it wants without blatantly saying, we need you to lose your jobs, right? So it's a tug of war with them. But the labor market, again, to me, makeup mode, when we get back above 157 to 158 million, then we start to get more interesting because, there's so many workers coming in when in a consumer-based economy that we have to serve a lot of people, right? So service-based economy needs a lot of employees because that's where technology doesn't really help you too much.
So, key to your model is a certain number of people filing for jobless claims. You've said it's 323,000. When we get to that level, then the Fed will pivot. Where are we on that level this week?
The jobless claims are nowhere close to 323,000. I mean, I would say this in terms of claims in jolts. Job openings came out this week. Job openings data is a little bit above 10 million right now. The Federal Reserve really puts all their weights on job openings data because they don't believe you could have a recession with job openings this high. Jobless claims, around 230, 240,000 is not anything troubling yet. But if we're able to get to 323,000 on the 4-week moving average, and that's not a made up number, I took the account of the civilian labor force job openings where we are. If we get to that number, then you got something. And guess what? We haven't even got close. right? So that to me will show that the labor market is breaking. Now, some of the Fed's comments this week were like, well, if the labor market's breaking, then I would be concerned. So I think they're a little bit surprised about how good the labor market is with all the Fed rate hikes. But if you look at it just as make-up demand mode, because it's confusing. On one hand, people say there's no workers, there's nobody working. Prime age labor force for women ages 25 to 54, all-time highs, right? I think those who know me said one of the more bullish cases in the United States of America, our women are tougher than our guys, right? They just are, they're the badass workers, right? We've got issues with men in this country since the 1950s, and it keeps continuing. But women, on the other hand, are pretty badass. And if you look at the history of the world, those that allow women to work and get educated and do that stuff, God, they're great, right? Those that don't, no, not that great, right? So I think it's such a bullish thing, because there was all these talk about, well, it's a she recession and women are kicking men's ass like they have, in the last 10 years. So I am all for that. I get so happy when I see that number, because people who've heard me speak before COVID know that's a big thing for me. But here, just make up demand, it's like in COVID-19 for housing, when we had that delay in home purchases for that 6 weeks, we had that big makeup demand toward the second half of 2020. Think of that about in labor, right? And then we get to a certain level, then things get a little bit more interesting. So it's hard when they say nobody wants to work, and yet we're having big numbers. The benefit for the United States of America has always been we have a massive young workforce. If we didn't have them, we are Japan, we are China, we are Europe, right? We don't. We have the luxury of having the millennials, Gen Z, and Gen A. This is a good thing. I call them replacement workers. So here, we're just getting back to a certain level, and then we take it from there. And hopefully that explains the 14 straight months of jobs data beating estimates.
Well, you talked about spreads. Let's get into the 10-year yield and mortgage rates, the 30-year mortgage rates. And, we had a lot happen. So we're recording this on Friday. It'll be live on Monday. But this week has been a lot of things happened, right? We got the debt ceiling deal done finally. We got these job numbers. So where are we on the 10-year yield and rates?
So the 10-year yield came all the way down to 3.60%. After the jobs data, it was going back and forth. I think right at this second is like 3.67%. So if you guys look at the 10-year yield chart, it's really starts to look like, lower highs. Again, for me, it's if I can't get myself under 3.21 until the labor force breaks or the labor market breaks. So that Gandalf line that I talk about is still there. The growth rate of inflation is falling. I don't know. I mean, outside of crazy people that want to see America explode, there isn't anybody that's really forecasting a reacceleration, just because the basic arithmetic, if you do have a second grade education and read, the CPI index is not on your side anymore for the next 12 months. So it's really hard to have a reacceleration of core CPI or even core PCE when the rental inflation is actually going to start declining in the data. But that would require reading, Sarah. And so the bond market knows this already. This is why I kind of kept that 3.21 as a solid line. And until the labor market breaks, when it does, it should, right? If it did break before that happened, then I got that wrong. Then the market is really trying to get ahead of the economic data. But so far, remarkably, Sarah, this is crazy to say this. With all the things that have happened in 2023, the 10-year yield looks perfectly normal to me. I would say that the banking crisis should have made it go a little bit lower, but it didn't. So the mortgage-backed security market is just, it's like a third world country. It's terrible, right? And the fact that the Fed has stayed silent on it, I think that speaks loud. They absolutely love the fact that the mortgage-backed security market is stressed, because that takes pressure off of them. In fact, I think they were, one of the reasons why they basically said, we're not going to sell mortgage-backed securities because it's stressed already, right? So I think a lot of desperate Americans who want to see this country crash are just hoping that they sell the mortgage-backed securities and somehow something breaks and people lose their jobs and all this stuff. But as of right now, they're kind of, okay, we're not going to do anything because it's already broken. So that's how people should look at it in that light. And historically, usually the spreads get bad when you go into a recession. So the question is, when we do go into one, what do they do? I think that is where we should start focusing a lot of the attention. What does the Federal Reserve do when we do lose jobs? What does the Federal Reserve do if mortgage-backed securities get worse and we do have 9 to 10% rates or something to that nature? If something terrible should happen, that's, I think, is a very, very interesting topic when we get there. But as of right now, the Fed's just trying to manage this and make sure that the 1970s inflation doesn't happen again.
Well, okay, so there's 10-year yield, but mortgage rates, we had another high. We hit a high for 2023 this week, up in the sevens. I mean, 7.3, 7.4. Some people were being quoted that James talked to. That has come back down, but give us a sense, like, come on, when can we say we're not going to go back into the sevens again?
Well, since the forecast had 7.25 in it,
I don't like that forecast.
I'm telling you, the biggest variable change of 2023 was the banking crisis, and the banking crisis has made the spreads worse. So we are here. The 10-year yield has to go back down to. I mean, it is so bad, Sarah. The mortgage-backed security market is so bad, but we should be at least 6.25, 6.5, something. But we're still in the high sixes right now. I don't think the Fed wants the mortgage-backed security market to be good. I see a bunch of older people afraid of people having sex and buying homes. It might sound ridiculous to everyone listening, but that's what economics is people rent, they date, they mate, they have kids. When they have kids, they buy more stuff, right? They need bigger homes. And this scares the people at the Federal Reserve because of the 1970s, right? 1970s, it was them. People like I'm telling them, they were the baby boomers buying back then. They had to deal with inflation. So in the back of their mind, they're thinking, oh my God, it's going to happen again. I lived it. I'm going to save the millennials. We're only going to have baby boomers buy homes now, right? And they're not having sex and having kids, so it's okay, But I honestly believe this. I think the fact that they have never commented on how bad the market is on the mortgage market is basically saying, haha, we love it. Too bad for you. You're not getting the 70s inflation. We're not going to make this happen. So take it for what it's worth. Again, stick to the labor market data. If claims start to break, 10-year yield falls. When 10-year yield falls, rates should fall. But the velocity of rates falling are just not that good right now. And that's the banking crisis. And they welcome the banking crisis. Not only did they welcome the banking crisis, they were raising rates during the banking crisis. So we have to deal with that. If they ever pivot to me doesn't mean rate cuts. It means language first. That'll be the more interesting period to see how the mortgage-backed securities mark when we actually see that turn. But unfortunately, this is the reality of the world we live in post the banking crisis. Remember, the Fed says, I don't see anything wrong. There's nothing wrong in the markets. All of a sudden, oh God, emergency lending. Oh, well, the banking system is fine. Oh, we need more mergers, right? So I know it sounds crazy, some of the things I say, but this is just trying to manage a marketplace. And the reality, on one hand, you have an institution that believes in facilitating full employment, but right now they're talking about price stability, and they do believe attacking the labor force is the best way to deal with inflation here.
Okay, let's talk about one of the other big things that we track. We do this every week with the housing market tracker, right? Is inventory. We did have some gains last week. What do you expect to see going into this weekend when you get the numbers?
So my inventory credit channel models have been very simple. Higher mortgage rates with duration, inventory growth can happen. Why? Because it takes longer to sell a home. What's occurred in 2023 is that mortgage rates have been going back and forth. And whenever they head lower, purchase application data does better. Whenever they go higher, they do worse. If you get higher rates with duration, it gives what you call a breather, right? Instead of homes selling at 15 days, they're selling at 22 days. Or if they're selling at 19 days, they're selling at 29 days. That can push the active listings higher and higher because you're not getting it in new listings. I mean, we're every week right now, 60, 70,000 people are listing their homes to sell, right? They're giving up their low mortgage rate. But what we've seen after 2010 is the real way for inventory growth to happen while people are employed are higher rates, duration, and the days on market actually have been coming back down again. So if higher rates get in, we should be getting more. The only thing is that we're in June now, right? And the seasonality of new listings data is actually kind of like after June, July. That period is when that data starts to decrease. And if that data decreases even more, man, it just means that whenever rates fall, the inventory group comes back. And that's just how it is because the mortgage rate lockdown wasn't ever a real thing. And there's a possibility, not a possibility, but if we stay the same trend as we are right now, we're going to have, I'm not kidding you when I say this, we're going to have some negative year-over-year inventory prints. That was not in anybody's playbook. But because the velocity of inventory last year, right, when rates started to spike above 7, picked up more steam, this year it's different. So I think it starts to get even more interesting tracking the weekly inventory data when rates are higher, because we kind of know what happens when rates fall. The mortgage rate lockdown didn't help. So
No. We won't even get into that. So, looking at the summer, I think you said like new listings was like the Walking Dead in the spring. And really the whole spring market was, as a result, very tepid, right? I mean, you had prices going up. That was maybe the biggest story about it was like we had so little inventory that prices really didn't come down like you would think.
It's interesting. If you actually look at the Case-Shiller index, if the Case-Shiller index, the month-to-month data stays the same toward the end of this year, it's going to hit an all-time high. Now, the FHFA and other indexes have already hit a high. Everyone's going to lose their mind if the Case-Shiller index hit an all-time high in 2023, because that just means that, a lot of bad housing takes in America just blew up in a lot of people's faces. Here, I would say this. The biggest story of 2023, the biggest story in housing economics was November 9th. And we don't have this discussion today if November 9th didn't happen. And for those that don't know, November 9th was the day that rates started to fall and purchase application data got better. So if I had to teach something, I would say don't focus on inventory levels. Inventory is higher this year than last year. It's not lower, it's higher. So we have more active supply this year than last year. So that's not the issue. The issue is that demand stopped collapsing. So when that occurs, right, we are dealing with supply and demand economics with what we know right now to be a fact. Stable demand with inventory near all-time lows. You cannot change this reality. It's just what the data has shown now. Now, if home sales were running from 4 million to 2 million, oh my, we're just keeping the same story. There's no shield with low inventory, right? And inventory should be even accelerating more, but that didn't occur. So this is why I stressed weekly housing data is the only way to track housing, because it's one of these sectors that can turn on a dime. And because it turned on a dime and nobody was tracking the weeklies, it's just, Sarah, I'm going to be really honest here. We have a lot of inexperienced people out there. You can see this. Why? You remember my thing? Everybody likes to do 10% price declines, 15% price declines, 20%. Nice round numbers. Everybody good. And they don't talk about anything else, right? So they forecast something and then what's your mortgage rate? I'm going to guess. What's the 10-year yield going to be? I have no idea. I don't. Okay, fine. Here we did something different in HousingWire, right? We said, okay, November 9th, rates are going, let's track purchase application data. Okay, from November 9th to February 2nd, mostly positive prints. What it did is it stopped the bleeding. That's the story of 2023. The bleeding stopped. And because of that, the whole dynamics of housing changed. And we were the only people that talked about it. Why? Because we track weekly data. That's the difference. People say, well, what's your 2-year forecast? Who is crazy enough to even do a 2-year forecast and let alone think that matters? Everyone, trust me, go look at everyone's forecasts. They revise it every month, right? This is a moving variable. Nobody wants to put the effort and time into tracking weekly data or what goes on data lines because they don't know, oh my God, that's work, right? So we'll do this, we'll track it. And this is why the weekly tracker data now gets more interesting because we're dealing with a variable change, higher rates. But the story of 2023 happened on November 9th. The bleeding stopped. If the bleeding didn't stop, it's different, right? We're going to go straight to 2 million. There's nothing preventing you from sales collapsing even more and more unless somebody has told everyone it's really rare to have existing home sales below 4 million. I don't know who that person is, but somebody has told you. And I encourage everyone, go read my Demographics Crushed Housing Bears 2020 article. It wrote in August when back then I said, existing home sales are going to be positive. Oh, every tomato that was left from the COVID-19 spare case was thrown at me at that point. They're like, no way, existing homes. Oh, yes, it is. It's going positive. No way. You're crazy. There's all these people unemployed. Forward-looking purchase application data is saying a positive. We were positive for the year. Let us do our jobs. This is our kingdom of heaven. Weekly data matters. Don't get stuck on yearly forecasts and don't listen to people who don't forecast. Come on. If there's anything I've taught any of you, don't listen to those people. They don't have the training or the discipline to do this. We do. So we're going to look at the second half of 2023, realizing that we have to do higher rates, how the labor market's going, the bond market, everything. And now we're dealing with credit getting tighter for the economy. We'll put it all in there, right? We're not a one-trick pony here. Economics, mother economics. Oh my God, she is the greatest serial killer in the world. She wants to get caught. She's going to throw a million different crumbs.
And I appreciate that. I can't wait until mortgage rates drop. I mean, our industry is just being squeezed from all sides. And so, and it's not good for consumers either. It's not good from any perspective.
If I had the Federal Reserve members here right in front of us, you know what I would tell them?
What would you tell them?
When the labor market breaks and the 10-year yield goes down, and let's say mortgage rates go down a little bit more aggressively, because so many people wanted to buy homes and they couldn't because they want rates to go lower, do you believe that is an effective way of trying to manage a housing cycle? Because you sure didn't care about rates spiking up higher. And what happens? Chaos. So chaos can happen both ways, right? There's a lot of people that were, hey, we have the demographics. It's not that, right? We believe in reading. Anybody who reads, we're not Japan. But if rates start to fall, now I know the Fed's kind of hinted they want this. Is that the kind of market you want in a rebound? Or do you want to somehow figure out a way to get the spread somewhat normal so you don't have like a rush of people coming in? Which then again, I start going back to my savagely unhealthy housing market game. And I don't want to do that, right? But this is the world we do in. So if I had the Federal Reserve, and I know some of the analysts there are listening, tell your bosses to figure out a way to make the spread somewhat normal, because we don't want what happened in 2021 again. Why? Because the total active listings are still low. So figure out a way to make this work, or else we're going to be in another bad spot again. We want a balanced housing market, and rates being this volatile resembles a third world country. We are the United States of America. Take some pride in yourself. Come on.
I am with you 100%. Logan, thanks for walking us through this. I did want to mention you were going to be at Gathering of Eagles on June 18th. It's coming up. We're having that in Austin. It is amazing. The kind of speakers we have there. We have you, we have Mike Simonson, we have Nick Bailey, the president and CEO of RE/MAX. We have got so many of the most amazing brokers and broker leaders at that. If you're in real estate, you should join us. Gathering of Eagles on June 18th in Austin, Texas.
Yes, and you all get to see me just absolutely destroy Sarah Wheeler's mortgage rate lockdown premise, and everyone can realize that the people with the data are going to win this one. So I cannot wait
You're
We might
awfully
even,
confident, you know. I mean, you know what they say. What goes before a fall there, Logan? Pride goes before a fall. So I don't think you should think you have this locked up at all.
this has nothing to do with pride. This is a math, facts, and data. And I've always stressed this. This has always been my cup of tea.
Okay, well,
I'm going to die on this. I die on this sword, die on this island. But I guarantee you, I've got the numbers behind me.
we will see. I have a lot of our listeners on my side on this, so we will see. But definitely come join us. It's going to be amazing. Logan, thank you so much.